like what this is how you want to think about options, just in general. Might be an easier way to explain it. But you want to think when you buy an option, you have a strike price. And people really don't like the way I teach this for some reason, but I don't understand why. But you're gonna have a strike price, and I want that on the left. And then you're gonna have a price you paid for the option, which is called a premium, which gives you a break-even price. So options always trade at a premium because what they are contracts that allow you to buy and sell shares at a certain price. So if we have a call, for example, you're able to call shares at 609, which means you can buy 100 shares at 609 if you own the 609 call until that call expires. So it's similar to like you could think like a coupon or something. You can buy SPY at 609 until the call expires for 100 shares of SPY. So each contract's 100 shares. If you paid $1 for the 609 call, your break even would be 610. So it's always trading at a premium. You buy it at 609, but your break even's higher. The reason that is because you're buying coupons. It's like you can buy SPY at 609 until Friday. What if it goes to 620? Right? It's like you have a coupon, you can buy SPY at 609 and sell it at 620 and make $11 a share. So when we're looking at this, if we pay $1 for that, your break-even price is 610. And then any time above your break-even price, every penny is $1 because you make 1 penny per 100 shares in the contract. So, for example, we'll just use my QQQ call that I bought yesterday as an example here. I'll pull it up for you. So it's up 149%, $600 total, and one of my call positions from yesterday. I had the 557 call. And I bought it at the same time I bought the SPY calls. So I bought the 557 call down here. It's 553, 554, give or take. So I bought it here. This was my call strike, 557. And you can see that was far away from where I bought the entry. But we were pretty high conviction that if it goes simultaneous 60, we're going back to all-time highs, which is what happened. So I paid $411. So I paid $2 about for this ability to buy 100 shares of Qs at 557. So these would be 559. So my break even is here on Qs. So you can see, arguably, is this a really good trade? Right? It's like, okay. But I expected this to happen either the same day or like the morning after, just because we have pivot machine gun. We had every reason to believe that was going to work. The whole market did it. Then we had simultaneous daily reversal. We had reason to believe it was going to work. And we talked about that yesterday. So I bought those calls. And at this point, you're going to see we are 255 above my break even. So 255 in the money, or not in the money, but 255 above my break even. How in the money are we? That's the distance from the strike price to the current price of the stock. I'll just say it's from here. So we are 450 in the money. So each one of these options contracts allows me to make $4.50 per share in the contract. And I have two in this case. So that is going to be $450. That's how much it's worth intrinsically. Because I can buy a share $4.50 lower down here, and I can sell that share at the current price, which is about $4.50 higher. So I make $4.50 a share per 100 shares in the contract times however many contracts I have. So when we're trading options, we want to think, if I buy this entry, where's my target? So if my target's this, I need this break-even price to be ideally below wherever I'm targeting. Because if we hit our target by Friday, I don't want to break even on the trade. I want to make money. So if we hit this target by Friday, I make money still. I'm going to make $1.76 per share on 100 shares, so $176. If we hit it before Friday, the price I paid, this break-even price, it's still worth something, so it might be worth more than that, which in this case, right, it's, I don't know how much they're worth a piece right now, but they're worth $5 a piece. So you can see from the strike price, where we could have these shares at, to here, current price, $4 in the money, but they're worth $5. It's because it's pricing in another dollar of movement between today, right now, and end of day Friday. So this is like really all you need to know. The last thing you need to know is how options are priced. So this break-even price, this is how much you're paying for it above that call strike. So if I paid 20 cents, it'd be here. If I paid $5, it'd be up here. What changes this break-even price is the volatility of the underlying stock and how much time you have. So if we look at URA, the calls I mentioned the 55s, right? So if we zoom all the way out, 55 calls here. Oops. They're at $4, so the break even is like 59. So this call, this is the break even. Let's say uranium, instead of moving like a couple dollars a day, let's say it's moving $10 a day. You might have to pay for the same option 3 times as much or 4 times as much because it's moving so much. Because you have to think someone else is selling you this options contract. So if someone's selling you a call, what they're doing is they have the shares. So like if they sold me the 55 call, they have the shares. Maybe they have the shares at $40, 100 shares. If they're forced to sell it at 55 to me, because I have the 55 call, they make money, right? But since it's kind of like an insurance type of game that they're playing, you want to think like, what's the likelihood of that happening? So if it's right down in here, like the likelihood of this happening going to 55 by 2027, likely, right? Because you have 2 years for it to play out, a year and a half, give or take. So they're going to sell that to me for $4. Now, if that call strike was here for 2027, they might sell that to me for $20 instead because it's so close and there's so much time. So you can think about the premium or the price you're going to pay for the option as the amount of time you have times how volatile the stock is. And that's your premium. So if it's moving 5 cents a day and you have 3 days left, the premium's probably around 15 cents, 3 times 5 cents a day. If it's moving $5 a day and you have 3 days left, maybe it's $10, $15, right? Now that's not like an exact pricing model, but what's more important for the pricing when you're trading them is, are you in the money or not? And where's your break-even price? And where's your target? So when we're looking at SMR, on stream, we talked about the SMR out of the money calls here, 37. So how much were the 40 puts trading Monday on SMR? Really cheap, probably, right? So those 40 puts, maybe they're like $2. Up in here at 50, those are $10. So if they're $2, at $2 for the 40 call, I mean, not put, the break even's 42 and our target is here, 45. So at worst, we make $3 a contract if we take this out before those expire. And at best, if it just keeps rocketing to the highs, you can make $10, $20, $30. So you're buying, it's like you get an option to own those shares at $40 and you're paying for the ability to do that. And that's really it.